So I just want to point out, since the end of October, Bitcoin, the S&P 500, TLT are all up about 5%. TLT is the number one kind of ETF that tracks the bond market. I think that's somewhat unsustainable. And crude oil is down 5%. To me, that's sustainable. What's unsustainable, I think, is both the SPY and TLT going up at the same pace. Now, James pointed out to me what part of what I think is happening in this great reset I started talking about a year ago, which I think now is entering the end of the beginning stage. We're just getting started. All the central banks are done hiking. We're seeing the problem with the auctions with way too much supply. Why do we have way too much supply? Because we did way too much fiscal stimulus, which was offset with more restraint from hiking rates. And I look at this as just the tilt starting to kick lower. So let's just see what's happened in the last few weeks.
In today's rapidly evolving financial world, Bitcoin's role as a digital gold and hedge against economic instability is more critical than ever. Renowned Bloomberg intelligence analyst Mike McGlone dives deep into the heart of current market trends, offering invaluable insights into Bitcoin's potential trajectory amidst global economic uncertainty. Moreover, the looming possibility of a global recession has put traditional and digital assets under the microscope. As governments and central banks grapple with policy decisions, investors and enthusiasts keenly watch Bitcoin's response to these macroeconomic shifts. McGlone elaborates on Bitcoin's comparative performance against other assets, particularly in a risk-adjusted context. His analysis, juxtaposed with recent economic developments, provides a comprehensive understanding of where Bitcoin stands today and how it might navigate the uncertainties of tomorrow. Recently, we've seen significant shifts in traditional markets, with bond yields fluctuating and the stock market experiencing its ups and downs. In this environment, Bitcoin has emerged as a notable player, often defying traditional market correlations. McGlone points to the decoupling of Bitcoin from other risk assets, indicating its growing maturity and appeal as a hedge against economic instability. Let us now get into the video. Make sure to hit the like button, subscribe, and drop your comments below.
The other thing I wanted to point out, you might have saw me typing when we were looking at this, is you look at volatility in Bitcoin versus TLT, annualized or annual measure, it's the lowest ever. It's about 2%. So that's one key problem I've had with Bitcoin versus Bitcoin versus SPY. It's about 3% three times that volatility, but it's just dropped to a new low. In Bitcoin versus gold, it's about 3 times. So that's one thing I'm really worried about when we get this normal correction in the stock market for a recession. We still haven't had it. And that's why I like to point out is since the month is great, it's great to be bullish Bitcoin, but the S&P 500 on a risk adjusted basis is up a lot more because it trades, Bitcoin's 3 times the volatility and up about the same. Now that's in end of October. That's a key thing. I mean, I'm obviously tilt a little bit more bullish Bitcoin, but I'm really concerned of there's so much of that hopium that Bitcoin's going to go up for an ETF. And I look at it, well, TLT's up and SPOI's up, and they trade at a fraction of the volatility Bitcoin does. The Fed always has injected liquidity since 1950. Every time the S&P 500 is down 20% on a 12-month basis, the Fed has always eased. One exception, 1988, because it was after the crash. So that's what's changed, but you have to be assuming and expecting that'll happen. But you need the risk assets go down first. That hasn't happened. That's just been my premise. Key thing is Bitcoin's broken above 30,000. That's what I needed to see a sign of strength, but it's still doing it for, to me, the wrong reasons. All risk assets are going up. That's the problem. I want to see it go up when risk assets go down, like the S&P 500 still up 15% on the year. So that to me is still what I'm worried about happening is you're just getting more gamma and you have a higher delta in Bitcoin. You want to see, I think, what you're saying to happen. That just we haven't had the test yet. That's what I'm worried about. So that's why I still stick with the hardest thing to do for, I think, type A's investors is not so much do nothing. So look over that U.S. government Treasury 2-year note and the 10-year notes and the entire curve. It gives you 5% and say thank you very much. And I think that's a hard thing, and people are not going to realize how to do that until risk assets go down. The key thing I think is we haven't had that scenario yet. We did a little bit last year, and you saw the example. Everything went down. We destroyed the altcoins, and I think they're destroyed forever, with the exception of maybe a few, which you've mentioned, because there's so many silly ones. But we haven't. Let's just look at this year to date. You look at the screens, you're like, okay, all risk assets are up. Bond yields, yields are up. Bond prices are down. And Bitcoin's leading. Okay, well, that's the exact opposite of last year. So I'm just pointing, yes, there's good reason for that. Now we have this ETF coming, but that's again, I agree with the fundamental big picture, like I said, but we haven't had normal correction for a recession in the stock market. And I think the point is now we're at the stage that since most economists think it's not going to happen, and the Fed's kept tightening, and most of my demand indicators, and look at the thing we all love is bottoming unemployment. The Psalms rule, it's just getting started. That when markets are complacent, most economists think it's different this time. That's your opportunity.
Moody's Investors Service just reminded Biden's White House that the stakes are rising and fast. On November 10, the last credit rating company to grade Washington triple a warn a downgrade is coming, and perhaps soon. Moody's cited the U.S. debt topping $33 trillion and political polarization throwing fiscal management into chaos. This adds an awkward subplot to the Biden-Xi tete-a-tete on the sidelines of this week's Asia-Pacific Economic Cooperation APEC summit. For all the challenges she faces in Beijing, slowing growth, property sector defaults, deflation, aging demographics, Biden faces daunting odds in stopping Moody's from dealing his administration a humiliating blow. McGlone now dives into the labor market, unemployment ratings, CPI, and PPI. Let's hear what he has to say.
Because I've read so much about this weekend, and I deliberately ignored it because there's so much about long-term and short-term and all that stuff. And the lesson I learned years ago is, okay, I just get confuzzled with those kind of things, and unemployment's going up. I mean, all the stuff in between, it's like I let the economists deal with, but I want to really point out, to me, the thing I had to publish on today, it's the idiot versus genius factor. And last year, I felt like a complete idiot for a while and saying crude oil is going to go down. Now I'm feeling like a genius, which means it's probably bottom, but you got to get to those extremes. And that's why I think next year, I feel like a complete idiot in TLT right now. And I felt that way in GBTC at the end of last year. And look what happened. I think that's what's going to revert next year. I think that TLT, since I have the complete idiot feeling that it's going to be one of the best performers next year, and I'm hoping Bitcoin can go up with that. But the tilt is all there. Sometimes it just takes one day for the flip.
Ask yourself this question, Mike, and what is the factor that drives TLT to go higher?
Simple, one word: recession. So we do have CPI this week. It's expected to drop to 3.3%. Our economists are taking the under on that. But remember, the peak was around 9%. And what's Fed funds? 5.5%. What's the body in motion? Here's one good example. PPI's low this year is 3.1% negative. That's deflationary. You know what the high was in 2008? Plus 10 or 9.9%. We are tilting towards severe deflation, and the Fed's still hiking rates. The Fed started cutting rates in 2007. And I have to push back on Dave a little bit because what he said about the 1970s is completely not true. That took decades. I've been rereading The Empire of Wealth for the third time. It took decades to get there. We both lived that. Remember the energy crisis. What got this inflation was one simple thing that's completely reversed. The biggest pump in liquidity in the history of mankind is now going back on the sharpest rate hikes ever. We're just getting started. That's my great reset. So it's the simple rules of Milton Friedman, and too much money creates inflation. Now we have negative M2 money supply. We have the tilt towards deflation. The Fed's still hiking, and we're just getting started. So I like to say this is the beginning of the end of the Great Reset. What we're going to see starting next year is the true deflationary, true recession. Now, starting in Europe, you see the data latest out of China, and all my data for U.S., except for the stock market, are pointing towards, okay, this is early days. Well, they probably won't, but the key thing is what's the next trigger to make them ease? And we all know, here's the thing, core CPI, core is running 4%. Their target's 2%. It's very simple. Unless you get a significant crash or breakdown or something to really break, there's no reason for them to ease. Even think about it. It's just the way, that's what's changed versus everything I grew up with when they would always ease when there was, a reason to do it. Right now, inflation is 4.1. It's the back. It's, to me, it's a classic lagging effect of the biggest wealth effect in history, still trickling down, and one of the biggest fiscal stimulus periods ever without a war, recession, just starting to tilt towards what the normal repercussions.
Inflation in the U.S., as measured by the change in the Consumer Price Index, CPI, declined to 3.2% every year in October, the U.S. Bureau of Labor Statistics, BLS, reported on Tuesday. This reading came in below the market expectation of 3.2% and September's inflation print of 3.7%. The core CPI, which excludes volatile food and energy prices, rose 4% in the same period, compared to analysts' estimate of 4.1%. Every month, the CPI remained unchanged, while the core CPI increased by 0.2%. The index for shelter continued to rise in October, offsetting a decline in the gasoline index and resulting in the seasonally adjusted index being unchanged over the month, the BLS said in the press release. The energy index fell 2.5% over the month as a 5% decline in the gasoline index more than offset increases in other energy component indexes. Assessing the impact of the U.S. inflation data on markets, the CPI report joins the non-farm payrolls NFP report, which showed an increase of only 150,000 jobs in October. That was below the pre-pandemic norm of just under 200,000, but still pointing to growth, said FX Street analyst Yohei Elam, and added, "A soft landing scenario is perfect for stocks, as companies benefit from both lower rates and healthy consumer demand. For the U.S. dollar, the data is adverse. Expectations for lower borrowing costs weigh on the greenback, while the currency does not benefit from safe haven flows. A recession is not on the horizon." Although Federal Reserve officials remain committed to the data-dependent approach to monetary policy, the Federal Reserve, Fed, is widely expected to leave the interest rate unchanged at the 5.25% to 5.5% range this year. According to the CME Group FedWatch tool, markets are pricing in a more than 80% probability that the Fed will stand pat on policy at the December meeting. While speaking at a conference organized by the International Monetary Fund, IMF, last week, "We are making decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation," Fed Chairman Jerome Powell said. Mike McGlone, however, believes that the recession will be on full gear by early next year, and while he is bullish on Bitcoin, he thinks the macroeconomy won't be favorable at all. Do you think McGlone is correct in this prediction? Let us know in the comment section below. Also, don't forget to like, subscribe, and turn on your notifications. Thanks for watching.